Good morning, everyone. Welcome back to our morning calls here at Guardia. We do them Monday, Wednesday, Friday, live at 9 a.m. And of course, you can always watch the replays and let us know in the comments or ping in our Discord for any questions, comments. The idea is to make it interactive and engaging. So Wednesdays, we're going to do a little bit more thematic, educational stuff. I mean, this month has been unbelievably interesting. I mean, the U.S. equity markets have been really interesting. What's been going on with inflation and interest rates. Of course, won't bore you to death. I always end up down that path of interest rates and what the Federal Reserve is doing to puppeteer some of our lives. But this morning I'm going to focus on tech, predominantly big tech. When I say that, I mean US large technology companies that we all know and love and hate. They can be software, they can be social media, they can be hardware, anything that is captured within that realm of being within the NASDAQ or in the S&P. Because they're a little more diversified. But the point is that this has been the golden goose of any investor this year. Depends what price you paid historically for one of these tech companies, but if you started from zero and began investing this year, you've done exceptionally well if your concentration, your asset allocation has been concentrated or focused on technology. With that said, we're halfway through the year, a little bit more now. A lot of people have done really well, and they're wondering, do I invest more? Do I cut my losses? Do I diversify? And this kind of brings to question the core thesis that everyone should have prepared when they begin an investment journey. Now, conventional wisdom says, do not start investing or speculating or putting cash into brokerage accounts and investing in public companies or going into exotic things like alternative investments or private equity that now it's funny that we get Instagram ads for these things now. And conventional knowledge says, have a job, steady stream of income, save an emergency fund, max out your retirement funds. Then you can think about other things. You can, in parallel, try to buy a home. That's a very sort of conventional American wealth building thing. Won't get into that. Too long didn't read version of that is that a home loan is the largest loan the typical person can get. So that's why it's conventionally considered one of the best ways to build wealth. But it's also one of the best ways to take on enormous debt that you may not be able to cover and maybe mistime the market with the price of your loan, etc. Again, won't dive in. But the point is that there's never the perfect time for starting. There's never the perfect time for asset allocation. And a lot of actually Guardia customers and users have chatted with me one-on-one about our model portfolio. And I've gotten questions like, well, do you trade it? Why don't I see you making changes? That's a really good one. Another one has been, is this your only allocation or is this your whole strategy? How do you visualize this? How do you make money? In a hyperbolic way, it is a model portfolio. Two great questions, and they boil down to what's investing versus trading. How do you make investment decisions? How do you make asset allocation decisions? And then how do you make trades or changes if you need to? And what's that based on? I've diverted a little bit from the technology conversation, but I promise you that it connects here because everyone is staring down the barrel of the tech earnings that have started to come in, paralleled with, and I told you I would try to avoid it, paired with the FOMC, the Federal Open Market Committee, having their meetings and talking about what they're going to do with interest rates and what's going on with the economy. If you haven't noticed yet, you can't separate those two things. And it seems ridiculous, right? Like, why is tech so sensitive to any talk about interest rates? And it has a lot to do, we'll dive into a separate conversation about that, but it has just a lot to do with what cash does for technology companies. What does capital do for technology companies? And the secret bullet, the silver bullet of a tech company is its ability to scale within a network of users who are on phones, who are on computers, especially if we're talking software or some sort of media deliverable. That's their secret bullet. So if they can prove user growth, they can, the dollars are implicit, The financial benefits are implicit. It's like, okay, well, we have so many people, we're so scaled up that even an incremental fee or incremental product sale translates into mass amounts of return and growth. So when cash was cheap, it was an obvious allocation. Now that cash is more expensive, interest rates above 5%, people are more careful. They want to invest in tech companies that not only have the capacity to scale when they have access to tons of cash, but have the capacity to scale with less cash. And when they do scale, the monetization is not deferred. It's not wait 10 years for us to acquire 1 billion users and then we'll turn on the light switch, like we're seeing with companies like Facebook, like Twitter, like Instagram. If you've noticed over the last 2 years in particular, there's all these extra monetizable little features and now little fees if you want extra benefits. That's the spring-loaded trap of a 10-year plus plan. I mean, that is why they were able to access cash so freely and so cheaply, but that has more to do with the larger economy and what the government was doing, but that's why they benefited enormously. Over the past 2 years, you've seen it. It's been a roller coaster ride. Big US tech companies, Facebook in particular, absolutely clobbered since 2020. Zuckerberg appearing in Congress. And it was one of my favorite companies to talk about with fellow contrarians at the time. People were very bearish on Facebook, and now it's I think definitely the top performing stock in our portfolio this year. And just presented an enormous amount of value and monetization potential. There you have it. So what's going on today? Today the Fed is talking. Looks like they're going to raise interest rates. That's what the market believes. If you check the stock market every day, which I don't recommend you do if you want to be a long-term sort of wealth-building investor, you'll see that U.S. markets kind of opened a little bit shaky. They're looking at the Fed meeting. They're nervous that interest rates are going to go up and that's going to kind of put a ceiling on the U.S. tech insanity rally, positive growth we've seen this year with companies recovering a lot of what they lost last year. So there's nerves about that meeting. The second piece is earnings. So every 3 months, companies report their corporate earnings, and paired with those earnings, they try to give investors an outlook for the next 3 months and potentially the next year. They'll make some comments, right? The larger the company, the more important these comments are, the more volume that people trade this company, the more important that those reports are as well. And of course, the analysts at large banks, at some hedge funds, myself, occasionally, or they always do, I'll jump from company to company every now and then, will produce what they think the company's going to report for earnings. And the performance of the stock on that given day has a lot to do with what the actual numbers are, how much money did they make, what were their margins, did they grow, versus what the analysts thought was going to happen. And so there's a lot of nerves because we're seeing a meeting about interest rates, and then we're also getting corporate earnings. And some of the larger tech companies like Microsoft are putting forth a somewhat negative outlook for the next 3 months. And so after a year where you look back and you see the NASDAQ is up more than 30%, tech investors are going to see these earnings, they're going to see this Fed meeting, and they're going to say, hey, maybe we dial it back. Maybe we kind of take our chips off the table and we call it a year and look out for a correction in some of the prices of some of these major tech companies. That's a little bit where I'm at. I mean, in the portfolio update video, I sort of mentioned that very happy with a lot of the picks in the portfolio, and going back to that conversation of why aren't you trading it? Why don't you make changes? Because the portfolio is designed to be long only. It's designed to have an outlook of 12 to 24 months before we start making any major assessments or shifts. The idea is you put forth a lot of research, a lot of time into making these picks. You define kind of the boundaries that you're comfortable being an investor in, and almost everything that I have in there, even if there were a major correction, would be something I would remain fairly high conviction on. Including some of the negative components of the model portfolio that haven't quite kept up with the euphoria we've seen this year, such as energy, such as Penn Gaming, one of the names in there in particular. India has trailed a little bit. Our European ETF, our European high dividend corporate ETF. So it's designed in that way. I do it because if I were trading actively a portfolio, I think I would make more mistakes. That's not my background isn't in trading or making markets. My background is in working with portfolio managers and CIOs and that sort of thing, and structuring, very long-term, strategically driven portfolios. There's a difference between strategy and tactics. Strategy is, what's our time frame? 1, 2, 5, 10 years. What are the rules governing some of our decision making? Filter the universe of investments that we want to test across these rules. Reduce the selection. Pick the stocks. Stick to the plan. And then when things get really crazy, that's when you start to make some changes there. So what does this have to do with US Big Tech? US Big Tech has taken the last 2 years to try to pivot, to try to get ahead before things get too tumultuous. There's certainly been a shakeup. COVID was a big test for them. They passed with flying colors, but at the end of COVID, you saw things like Meta investing in the metaverse, Elon Musk buying Twitter, Google having to restructure, having to lay people off. I mean, all of the titans of technology have had to make a change or tried to make a change in order to anticipate a little bit of the volatility that we've seen both in the market, the economy, and kind of in consumer behavior as well. You have the rise of TikTok, I forgot to mention that one. And so all of these techs are sort of fighting for their life. They're having an existentialist crisis. We have Twitter as X, we have Facebook as Meta, but now turning back towards AI, Google getting kind of left in the dust in AI with OpenAI and going through its own thing. I have faith in Google. However, I think, as usual, they'll likely come out on top. And these are concerns that investors should be concerned about as well. And I think that any of the excess return is return that is beyond the benchmark. In the case of talking about tech, we think about the NASDAQ as the benchmark, the point of comparison. And any return above that benchmark, if you ask me, comes from the buzzword AI. And this earnings report kind of is that first acid test of, okay, was AI a buzzword last quarter? Or are you materializing? Do you have new products? Do you have new businesses? Do you have new customers? Do you have new revenue, new margins? Are you more efficient because of AI? And so now with this round of earnings, they're being tested on that, and then they're being directed at where interest rates are going in the near term and how conditions might not be so euphoric for them. An extra boost that helped tech last quarter was the fact that they kept interest rates flat. The Federal Reserve pointed at inflation. They said, hey, inflation's coming down. We're going to pause interest rates for now. Market took that info and said, let's put more money in tech. Conditions are going to get more favorable. And with this AI revolution, it's going to be even more favorable. So it's not so vanilla, right? Like you have the AI pushing tech up, but then you have tougher conditions, higher expectations, existential crises for these mega tech challenging them. And so I think this next couple of weeks should be pretty interesting there, with a lot of pressure for them to perform and give positive outlook for the rest of the year. It wouldn't surprise me if we see technology take a little bit of a hit in the next couple of weeks. Does that change my view on the underlying model portfolio? Definitely not. Not for now. That's not enough. There would have to be a lot of different things that would have to go wrong and change drastically for me to reposition my view on US tech. I think it's still positioned for incredible growth, but the timing can be tricky. That's another thing with this, and that's why the portfolio is mainly static unless there's major sort of strategic shifts, is because timing is tricky. So we got a little bit lucky with the timing, finding these things very attractive when they were cheap at the beginning of the year. Now is not the same case. Now you have to think a little bit more tactically if you are thinking short term, and that's kind of the difference between those two worlds, right? And usually when you run, a hedge fund or asset manager, you have both of those pieces. You have the generals sort of making the mandates and the core decisions, and then they outsource the daily management to the traders and that kind of thing, whose responsibility is either to generate extra returns with those mandates, not lose money with those mandates, or be vigilant in case there are sort of rogue waves in the near term that could disrupt that more longer strategic view. So hopefully that was fun for you guys. We'll catch up again on Friday. Take care. Any questions, any comments, any articles you want to share, pop them in the Discord. If you don't know how to find that, visit us on www.guardia-capital.com. Take care, guys.